Did you know that the way your investment are structured could significantly impact your tax liabilities? In today's video, we are diving into Section 17 of the Companies Income Tax Act, which deals with the taxation of profits and income from authorized unit trust schemes. By the end of this video, you will gain a comprehensive understanding of how authorized unit trust schemes are treated for tax purposes, the specific tax implications for trustees and unit holders, and the key definitions you need to know to navigate these laws effectively. As usual, we will be giving literal interpretations, insightful analysis, and illuminating case studies to clarify this section. So buckle up. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Section 17, Authorized Unit Trust Scheme. Where under any of the provisions of the Investment and Securities Act, a unit trust scheme is established for the purpose of providing facilities for the participation of the public as beneficiaries under a trust in profits or income arising from acquisition, holding, management, or disposal of securities or any other property whatsoever. This act shall, in respect of the income arising to the trustees of an authorized unit trust, have effect as if the trustees were a company whose business consists mainly in the making of investments and the principal part of whose income is derived therefrom, as if the rights of the unit holders were shares in the company, and as if so much of the income accruing to the trustees as is available for payment to the unit holders were dividends on such shares, and reference in this act to a company shall be construed in accordance with this subsection. For the purpose of Section 32 of this Act, the profits of an authorized unit scheme on which tax may be imposed shall be ascertained by taking the income accruing to the trustees from all sources of the investment of the unit trust and deducting therefrom sums disbursed as management expenses, including remuneration for the managers. Where the trustees of a unit trust receive a payment on which the unit trust suffers tax by deduction, not being frank investment income, the tax thereon shall be set off against any income on the trustees by an assessment made for the year of assessment in which the receipt on which the tax deduction was made falls to be taken into account in ascertaining the tax payable by the unit trust for the year of assessment. The provisions of Section 53 of this Act shall apply to a dividend accruing to the trustees of a unit trust. So much of the profit accruing to the trustees of a unit trust as is available for payment to unit holders or for investment shall be deemed to be dividends paid or payable by the trustees to the unit holders in proportion to their rights, and the provision of Section 21 of the Personal Income Tax shall apply to a dividend paid or payable to any member of an authorized unit trust. In this section, authorized unit trust means, as to respect a year of assessment, a unit trust scheme that is authorized by the Commission under Section 125 of the Investment and Securities Act to carry on the business of dealing in a unit trust scheme. Unit trust scheme means any arrangement made for the purpose of providing facilities for the participation of the public as beneficiaries under a trust in profit or income arising from the acquisition, holding, management, or disposal of securities or any other property whatsoever. Unit holder means any investor, beneficiary, or person who acquired units in a unit trust scheme and who is entitled to a share of the investment subject to the trust of a unit trust scheme. Trustees under a unit trust means the person in whom the property for the time being subject to any trust created in pursuance of the scheme is or may be invested in accordance with the terms of the trust. Interpretation, analysis, and case studies of Section 17, subsection 1 to 5. Literal and simple interpretation. This section of the law talks about unit trust schemes, which are arrangements that allow the public to benefit from profits or income generated from investments in securities or other assets. The section states that for tax purposes, the trustees of an authorized unit trust should be treated as if they were a company focused on making investments, and the unit holders should be treated as if they own shares in that company. The section also explains how the profit and tax of the unit trust scheme should be calculated and how certain payments and dividends should be treated for tax purposes. Analysis. This section focuses on the taxation and treatment of profit and income arising from authorized unit trust schemes under the Investment and Securities Act. It outlines the provisions for treating the trustees of the unit trust as if they were a company mainly involved in investments and the unit holders as if they held shares in that company. This classification impacts the taxation and treatment of income and profits derived from the unit trust. According to the section, the profit of the unit trust scheme should be calculated taking into account the income of the trustees and deducting management expenses, including manager remuneration. It also addresses the set-off of taxes paid by the unit trust on certain receipts against the income of the trustees, and it specified the application of Section 53 of the Act to dividends accruing to the trustees of a unit trust and the treatment of profit available for payment to unit holders or for investment as deemed dividend paid to the unit holders. Case studies. Case study 1. Consider Sarah a trustee of an authorized unit trust scheme that earns income from various investments. According to the law, the trust should be treated as if it were a company mainly involved in making investments. This means that for tax purposes, the trust will be subject to the same rule that apply to companies when it comes to calculating and paying taxes on its income. Case study 2. John is a unit holder in an authorized unit trust scheme where he receives income from the profit generated by the trust. Since the law states that for tax purposes, he should be treated as if he owns shares in a company. Therefore, the income he receives from the trust should be treated as if it were dividend paid on shares of a company, and the tax treatment should align with the rules that apply to dividends. Case study 3. Consider an authorized unit trust scheme that earns profit from an investment and trustees need to calculate the taxable profits. The law specifies that the profits should be ascertained by taking into account the income from all the trust investments and deducting management expenses, including manager remuneration. This calculation method ensures that the taxable profits accurately reflect the income generated by the trust after accounting for related expenses. Case study 4. Consider another unit trust that receives a payment on which it suffers tax by deduction, and the law allows for the set-off of this tax against any income received by the trustees. These provisions ensures that the tax paid by the trust on certain receipts can be offset against the overall income of the trustees, which align with the principle of fair taxation and prevent double taxation. Now, let's move on to the interpretation, analysis, and case studies of Section 17, subsection 6. Literal and simple interpretation. This section defines key terms related to authorized unit trust scheme for the purpose of taxation. Authorized unit trust refers to a unit trust scheme approved by the Commission to engage in the business of dealing in a unit trust scheme. Unit trust scheme denotes any arrangement designed to provide the public with the opportunity to benefit from profits or income arising from the acquisition, holding, management, or disposal of securities or other properties. Unit holder pertains to any individual who has acquired units in a unit trust scheme and is entitled to a share of the investment subject to the trust of the scheme. Trustees in a unit trust context represent the individuals in whom the property subject to any trust established in line with the scheme is or may be invested in accordance with the trust terms. Analysis. The section provides definition crucial for understanding the subsequent provisions related to authorized unit trust schemes. This helps in accurately delineating the entities and components involved in such schemes, thereby ensuring clarity in the application to taxation laws. By defining authorized unit trust scheme, unit holder, and trustees, the section sets a concise framework for interpreting the subsequent clauses and understanding the tax treatment and obligations specific to these entities within the context of unit trust schemes. Case studies. Case study 1. Tom wants to invest in an authorized unit trust and decides to understand the meaning in the context of taxation first. He learns from the definition of the law that an authorized unit trust must be approved by the Commission and it engages in the business of dealing in unit trust schemes. This definition helps Tom choose an investment that qualifies for the specific tax benefits, such as preferential tax treatment on profit distributed by the trust, thereby optimizing his tax strategy. Case study 2. Lisa, an investor in Nigeria, is evaluating whether to invest in a unit trust scheme and want to understand its tax implication. According to the law, she learns that it refers to any arrangement designed to provide the public with the opportunity to benefit from profits or income arising from the acquisition, holding, management, or disposal of security or other property. This understanding helps Lisa choose a unit trust scheme that meets her investment goals and also provide favorable tax treatment on her returns. Case study 3. John, an investor, wants to understand his status as a unit holder in a unit trust scheme. He learns from the law that a unit holder is any individual who has acquired units in a unit trust scheme and is entitled to a share of the investment subject to the trust of the scheme. This knowledge informed John that his share of the profit will be treated similarly to dividends, potentially subject to different tax rates than other income. Case study 4. Sarah, a newly appointed trustee for a unit trust scheme, needs to understand her role according to the law. By referring to the definition provided, she learns that trustees in the context of a unit trust scheme represent the individuals holding and managing the trust assets. Sarah uses this knowledge to ensure compliance with tax laws, thereby fulfilling her duties and safeguarding the trust's financial health. In summary, this section addresses the taxation and treatment of profit and income from authorized unit trust schemes, providing guidelines for how trustees and unit holders should be treated for tax purposes and how profits should be calculated and treated. It also provides essential definitions related to unit trust schemes, which are pivotal for interpreting subsequent provisions. This comprehensive approach ensures clarity in the application of taxation laws to these entities within the context of unit trust schemes. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.